Hey everyone, today was quite a day for crude oil. We saw the futures trading at a negative number for the first time in its history. So remember where you were today when that happened, because I think this will go down in the history books as a day we look back on. So if you missed the action today, we're going to basically go through, what happened. And for people who are wondering how they can get involved in oil, we're going to go through some of the different options. So the first thing, I took this screenshot earlier. This was, before the price went negative, but the futures on crude oil, they dropped negative 99.95% on the way to 1 cent. Okay, and this is just today. And you should note that this was before the price went negative. So here's the candle bar that you can see where it went down on April 20th. And if we were to go look at the chart, you can see here the price went all the way down to around negative $40. So basically the idea is if you have room to store oil, then someone would actually pay you to take it off their hands because there's just nowhere to store it. It was in the Earth's crust. It's now longer no in the Earth. It's now no longer in the Earth's crust, and storing oil is expensive. And for a lot of people out there are always wondering, why can't I just buy oil at spot price? It's one of the most common questions you'll see is why can't I just go on some exchange and purchase oil? Well, it's more complicated than that. It's a commodity, and there's prices that come with storing commodities. And the reason why the price went negative today, in short, is because the futures contract for May is expiring, and a lot of people, a lot of retail investors, in this case, this is not always the case, but in this case, it was a lot of retail investors coming in thinking they were buying cheap oil. When it turns out, they were basically falling into a trap where essentially the time for the futures contracts was expiring, and if you don't roll your contract over to a new contract, then you're going to get a notification as to where can they deliver your oil. But a lot of people don't actually have any intention on storing the oil. They just want to gamble on what the price is going to do, and then they roll their contract over when the futures contract is ready to expire. So what happened this time is the futures contracts were expiring, but the demand just wasn't there. A lot of times, at the end of the futures contract expiring, these industries will come in, people will come in, they'll buy up the oil. But in this case, the industries are shut down. Also, people aren't traveling, but certainly the industries are having a huge effect. The Chinese economy has taken a huge hit, probably the worst hit since the Cultural Revolution. Not that the Chinese economy was nearly as big back then, but nevertheless, the demand for oil just hasn't been there. People aren't using oil, industries aren't using oil, and a lot of people had oil with nowhere to put it. So what happened? The price went negative. So people who were, if you're sitting on a lot of tankers and you can store oil, I imagine a lot of them were buying up the contracts at negative 30, negative 40, and then they could instantly go into the futures contracts for June and sell it. And you're making instantly a $50 profit per barrel, because you can see that, for May, it was at around negative 30, negative 40. You can see again for June, it's at around $21, July, $27, and it continues to go up. This is known as contango. If it were going down, it would be backwardation, and that typically would happen in, say, an instance of a demand shock. But clearly we're not having a demand shock right now. People just don't want oil. So the issue is, if you have a place to store it, then you're the one buying up, and I shouldn't even say buying, you're getting paid to take oil off people's hands. You can then sell it. So a lot of people made a lot of money today. A lot of people lost a lot of money. Now, where does that leave people who are looking at this drop and wondering how they can get in on it, whether that means they want to go long or short? Okay, what can you do? Well, there's a few options. So one of the options you can do, and I'm not saying any of these is something you should do, but these are just some of your options. So the first one is USO. So with USO, this is the United States Oil Fund. It basically, it's an ETF, and it basically tracks the oil price. But it doesn't just track, a specific futures contract. It tracks a range of contracts with various levels of maturity. So you're not going to see something that's at, negative 99.95%, or even something that lost more than 100% in value, since we saw the futures prices going negative. But you'll still see, fairly significant drop off. So here is USO. So this is, you can see the drop we've had since March to present day, has been around a 62% drop. So if you're further going to bet against oil, or let's say you want to go long on oil, USO basically is longing oil. So if that's what your goal is, I know some people are going to be buying this up. Another idea is you could purchase stocks that highly depend on oil. So, ExxonMobil is one of those where obviously it's very, it does track, partially the price of oil and its stock price because it heavily depends on oil. BP being another one, so you could look into that one. And I'm not saying, to go long or to go short or what you should do, but I'm just laying out your options. So you could look into USO, the United States Oil Fund, that ETF. Buying that is essentially longing it. Obviously you could long Exxon or BP, or short Exxon and BP if you're going to bet against the price and you expect the prices of oil to continue to drop. And then subsequently you would expect the prices of companies that strongly depend on oil to also drop. And then obviously you could also bet on futures contracts, which is what a lot of people end up doing, and through leverage trading and through derivatives trading. And in this situation, what you would do is you would look, okay, well, why is the price, so the price for the June contract is at 21.35. So what does that mean? Well, if you were to go in and long this, it's already saying the market already is valuating oil at around 21.34 per barrel in June. So if you were to go in and long this right now, you're basically saying, I think in June the price of oil per barrel is going to be higher than $21. If it goes up to say $30, then you're going to make a profit. If the price of oil is say $10, then you're obviously, you'd be losing money if you're longing this. You could also go in and short this contract as well, and then you're saying, I think 21.34 is way overpriced. In this situation, I think what's more likely to happen is, the demand next month isn't going to be there either, and so I'm going to short this with the hopes that something similar to this month happens yet again. And obviously that's a huge gamble, because if economies do open up and industries get going again, then you might see this, you could easily see this not take the same trend as the futures contracts this month. So, again, I'm not telling anyone what to do here. Obviously, this is not financial advice. I'm just trying to lay out different options. You have the USO ETF. You could look at stocks that track oil. You could go into these futures contracts on crude oil. By the way, this is West Texas Intermediate, so this is in the U.S. The basically for petroleum, gasoline, that kind of grade. There's also Brent oil that is based out in the U.K. And there's plenty of others, but here we're talking about crude oil, West Texas Intermediate. So I hope this has been informative to everyone. You can see as you look at futures contracts further and further out. So if you want to gamble or speculate further out what the price of oil may do, then you can clearly look into different contracts. And as I mentioned earlier, you can see that as we move forward in time, the price of oil is increasing. Therefore, what the market thinks it's going to be worth at that time, and this is known as contango. And the reason why you need to know what contango and backwardation are is because, let's say you're going into a futures contracts and you're longing it, and at the end of the month, maybe the price is slightly higher than what you bought it at. Well, that doesn't ensure that you see a profit, because you have to roll your contract over to the next month, so you have to sell your contract. Otherwise, again, they're going to come asking, where do you want your oil delivered? And I imagine most people watching this don't actually want to deliver oil to their house or to their business, but they just want to bet on the price of oil. So you have to take into account the fact that if when you roll over to a new contract, that's essentially offsetting the cost of storing oil to the investor. So even if the price slightly goes up, you need to make sure or hope that it's offsetting even the losses that you would incur on the roll from one contract to another. So I hope this has been informative to everyone. I'm not really showing a lot of analysis here in terms of what oil is doing. But I'm just trying to lay out different options because I was getting pinged all day long with people asking, okay, well, what do I do? What do I do? If you're sitting on 100 different tankers and you can go fill those up, then just head on down to Oklahoma and you can get paid basically to take oil off their hands, and then you could then say sell that oil into the June contract. The issue is that everyone's neck deep in oil supply, and they just don't have anywhere to put it. So I think that's essentially what's going on. I hope this has been informative to people. And again, if you guys like the content, please subscribe to the channel. If you want, check out the Telegram channel in the description below if you want to jump into the discussion. With that said, I will see you guys next time. Bye.